our final trade of the day, Kevin Davitt of the Chicago Board Options Exchange joins me now to talk about the options moving ahead of Under Armour's earnings. So thanks for coming on the show today.
Thank you very much for having me.
Did you see some unusual activity?
We certainly see activity. Whether it's unusual, I guess, remains to be seen. But in terms of options activity in Under Armour, that product averages about 12,000 options a day. And before noon, preceding earnings, more than 28,000 options have traded. So it's certainly unusual in that respect.
So what are the options predicting for this earnings move? What can you derive?
That's a really good question. My typical process is to look at if a product has weekly earnings, to look at the weekly earnings the weekly options that correspond to the earnings. And so this Friday's options, I look at the at-the-money straddle, and that's the 20 strike in Under Armour, and it's implying a $2.40 range, so $22.40 on the top side, $17.60 on the downside.
A decent sized move.
Yeah, absolutely.
Any ratio on the puts trading compared to the calls?
When I looked at that $2.40 straddle, I then looked at the 17.5 puts, so roughly $2.50 out of the money, and the 22.5 calls. And that strangle is very much call skewed, meaning the calls are trading well over the puts. So perhaps the options market is telling us that Under Armour has more support or is closer to a bottom than a top here and now.
Well, that was my next question. Sometimes you can tell by the options flow of the paper, the puts trading versus the calls trading, and how much traders are willing to pay for those contracts.
Correct.
So are they willing to pay more to have call contracts or put contracts here, Kevin, would you say?
Right now, short-dated options imply that call contracts are what traders or the public are looking for. Now, what that means, I guess, remains to be seen after earnings this morning.
Right.
So, but here and now, it looks like volume is call heavy.
Call heavy, so that could be an indication that maybe traders think the stock could go up. It could also be indication that people who are shorting the stock want to have that upside exposure, because if they're shorting the stock, the last thing they want to see isn't a big explosive move in Under Armour and they are caught short. But the options that are on the call side could save their day, right?
That is a really, really good point, particularly in some of these retail names that have been under significant pressure, with the exception of Amazon, for the past couple of years. So that's a really, really good point and a testament to the flexibility of options.
Amazon's always the exception.
How about it?
Thanks to you for being exceptional.
Thank you very much for having me.